All right. So let's follow up on this a little bit. So in the last one, we talked about the fractional reserve system uh, and the deposit multiplier. And so we're kind of say, well, why does this work? Some of you might be thinking, I didn't know that the bank just kept a little bit of my money and loaned out the rest. And now maybe you don't feel so comfortable about the banking system. Don't worry. At least in the U.S., there's deposit insurance. So even if the bank does somehow go bankrupt, then your money is still protected. We'll talk a little bit more about why we have those later on. But the key is, well, if they don't have all my money, then what happens if I come to take it out, right? Then, does that mean they're only going to be able to give me 10% in a given day? Well, the answer is it works pretty well because, yes, it's true that if we all come at the same time, right, we would have a big problem. But generally, people don't do that. Okay, so people don't all take their money out at the same time. So that's the key, and that helps. So actually, what's usually happening is we have some deposits and some withdrawals. So each day they have withdrawals and deposits. So really, you might have $1 million of withdrawals and 100,000 of deposits. So again, they're fairly balanced, right? And so on net, they're going to be stable. These, well, you can say offset each other. So the net withdrawals is not usually large, right? After you consider the deposits, it's not usually that large. So the reserves will be more than enough in most cases to cover all of this, way more than enough to cover all of this. Okay, so that's something we have going on here that we should consider. Now, there is something here that is true. If everyone comes to take their money at the same time, the bank won't have it because they are only keeping a percentage, not always 10%, I just use that as an example, but they're only keeping a percentage of the money that has been deposited. So if everyone comes to take money, if you all come to take your deposits at the same time, right, the bank will, okay, so they won't have the reserves, they'll have to start liquidating assets and they'll get into big trouble. And this is known as a bank run. It was very common during the Great Depression. In fact, it was one of the factors that led to the Great Depression because lots of people would come to take the money out of the bank at one time, the banks would collapse, and then people started not to trust the banking system and keep more things in cash. And this deposit multiplier would work in reverse. So actually the money supply will be shrinking in that case because people are pulling their money out of the banking system, and as they pull money out of the banking system, the banks make less loans and create less new deposits. Okay, so we'll talk later on in next week about what policies the Federal Reserve plays and the banking system in general, regulations to try to keep this system stable, right? But it generally works pretty well. If there's a big problem, it could not work so well, although we have a lot of policies in place to try to maintain the stability of this. Okay. In the next video, I'll come back and talk about some of how this works in the real world, slightly different than what we showed in the theoretical idea.